Welcome, curious minds, to another deep dive. Today, we're taking a magnifying glass to a really specific dynamic region, the Antelope Valley real estate market. Our mission for this deep dive is to pull out the most important nuggets from the recent July 2025 data and the Q3 outlook. But it's more than just raw numbers, right? We're really asking, is the Antelope Valley's market, a resilient outlier? Or is it just maybe reacting a bit slower to the bigger economic shifts? We're going to peel back the layers,
Yeah.
homes, warehouses, the whole picture.
Exactly. And the Antelope Valley, it's what we call a submarket. It's this distinct area within Southern California, but it kind of has its own economic drivers, its own trends. Sometimes it operates a little bit independently from, the rest of the metro area. What we'll see today, I think, is that it really does have its own unique rhythm, and you need to look closely, beyond the general headlines to really grasp what's happening there.
Okay, yeah, let's do that. Let's unpack the residential market first. What are the latest numbers telling us about home prices? Palmdale, Lancaster?
Yeah.
What's the story there? And, what does it actually mean for someone looking to buy or sell right now?
Right. The critical thing to see here is that we're looking at a period of, moderate, stable price growth, not explosive.
Hmm.
So in July, the median sold price in Palmdale, it reached about $530,000. That's up roughly 3.9% compared to last year. Lancaster hit around $480,000, up maybe 2.8% year over year. Now, this isn't just a number. It really signals a shift. Unlike some other markets that got, super overheated, the Valley seems to be entering a phase of more sustainable, predictable appreciation, which actually makes it kind of uniquely attractive, maybe for long-term investors or first-time buyers who want stability. It sort of de-risks things a bit.
Sustainable, predictable. Okay, so prices are still climbing, yeah, but not at that frantic pace we saw a couple of years back. That sounds promising for buyers maybe, but
Yeah.
are they actually getting more selection? Is inventory finally loosening up?
We are definitely seeing inventory rise.
Yeah.
Palmdale had, 669 active listings in July. That was up a solid 5.0% just from June. And Lancaster's inventory grew by approximately 6.5% month over month. So this increase, it really shows the market has cooled down from that extreme seller's market last year. It's shifting, towards something more balanced, which for you, the buyer, probably means a little less frantic competition, maybe more time to think.
Okay, more inventory. That's good news. But it does raise a question about the pace, right? Are homes flying off the shelves like they used to, or are they sitting a bit longer? What's happening with actual sales activity?
Yeah, activity has certainly decelerated, no question. Lancaster saw 126 homes sold or pending in July. That's a pretty significant drop, actually, like 21% down from June's volume. Palmdale had 122 sales, which is an 8% drop month over month. But here's where it gets really telling.
Yeah.
How long homes are taking to sell. The average days on market in Palmdale climbed to 53 days. Now compare that to just 30 days a year ago. That's a huge, 72% increase.
Wow.
And Lancaster averaged 49 days on market compared to 34 last July. Still a big jump, 43%. These trends, they directly reflect, fewer buyers maybe, and definitely more inventory. Buyers get more breathing room.
Wow, yeah, a 72% jump in days on market in Palmdale. That is a dramatic shift. So does this mean bidding wars are basically history in the Antelope Valley now, or are some places still seeing that heat?
That's a really good question.
Mhm.
Because while the market has clearly cooled off, bidding wars haven't vanished completely. No, we're seeing roughly, 38 to 40% of homes sold in July still closed above the asking price. And about a third of sales in Lancaster went at or above list. But, and here's the nuance, another third roughly sold below asking price. So the market is cooler but not cold. So that makes sense.
Cooler but not cold. I like that.
Buyers are definitely more selective, but competition still pops up for the really desirable, well-priced listings, which means it creates an opportunity, right, for well-prepared buyers. You might actually have a bit more negotiating power now, especially if a home is maybe priced a tad high or needs some work.
Okay, so takeaway for you, if you're looking in Palmdale or Lancaster right now, patience, be prepared, know that competition's still out there for the good stuff, but you also have maybe a bit more leverage than before. All right, we've explored buyers and sellers, but what about folks who aren't quite ready for homeownership? That naturally makes you wonder about the rental market. Let's pivot there. How's that story unfolding in the Antelope Valley?
The rental market, it remains pretty robust.
Yeah.
As of mid-2025, the average apartment rent is kicking around $1,500 for a one-bedroom, maybe $1,800 for a two-bedroom. Three bedrooms are up in the high $2,000. But here's a kind of surprising detail. Rents have actually edged down just slightly, but 1% year over year.
Down.
Yeah, just a tiny dip. But it suggests that the Antelope Valley's rental market might be hitting this point of like equilibrium through its affordability. It seems to be absorbing demand without those really punishing rent hikes you see elsewhere. Probably because there's a steady, affordable supply, maybe a unique tenant mix focused on value, keeps vacancy low, keeps rents pretty stable, and the valley's lower housing costs keep pulling in commuters and remote workers from pricier coastal areas.
Interesting. Okay, let's pivot again this time to the commercial side of real estate.
Yeah.
What's the standout sector in the Antelope Valley's commercial landscape? What's really driving things there, and why is it so resilient?
Oh, industrial. Definitely the industrial real estate sector. It's the bright spot, absolutely. And it's really bucking the trend. We're seeing really strong leasing activity, local industrial parks, warehouses. They're busy. While some big Southern California markets are struggling with rising vacancies, the Antelope Valley is actually thriving in this space. It's benefiting from this sort of unique convergence, right? Demand in logistics, aerospace, manufacturing. Plus, it has the available land and crucial transport links like Highway 14. And of course, its proximity to Edwards Air Force Base is huge. All that momentum is keeping industrial lease rates firm, and it's even spurring new development inquiries.
That is pretty remarkable for industrial, especially when you hear about struggles elsewhere. Are there lessons there, maybe? For other commercial markets, looking at Antelope Valley's success in logistics and aerospace.
I think the lesson's pretty clear, yeah. You got to leverage your unique advantages, geographic, economic, whatever they are. Antelope Valley's location, its existing industry clusters. It creates this kind of self-reinforcing cycle of demand. Really highlights how specialized demand can sometimes trump general market conditions.
Makes sense. Okay, what about retail? How are retail properties doing, especially since consumer habits have shifted so much, post-pandemic?
Retail's actually doing pretty well, especially those neighborhood and community shopping centers, the ones serving local needs. Suburban retail demand has turned out to be surprisingly resilient. And the Antelope Valley is actually one of the stronger submarkets in LA for retail demand, partly because it has so many centers just serving the local folks. The metro-wide retail vacancy rate is healthy, around 5.4%, and the popular centers in the valley, they're often near full occupancy. Rent growth, it's been positive, but, modest, maybe 0.2% annually. And here's a critical point. There's very little new retail being built there. So the existing, well-located centers, they've seen steady or even rising rents because national retailers, local businesses, they're all competing for that limited space. Foot traffic seems pretty solid too. Supports the stability.
Okay, so industrial is booming, retail is holding steady. That brings us to the office market. That seems to be the struggle nationally, right? I can't imagine the Antelope Valley is totally immune to that.
You're absolutely right. Yeah, the office market is still the soft spot in the Antelope Valley. It mirrors what's happening pretty much across the country, that lasting impact of remote work. The local office sector there is grappling with high vacancy rates. It's similar to greater LA, where vacancy roughly doubled, went from maybe 5% pre-pandemic up to around 11% by early 2025. A lot of firms have downsized or they've put expansions on hold, leaves a lot of empty space. So landlords, they're responding. You see competitive leasing incentives, flexible terms, lease rates have definitely softened, tenants have more bargaining power. Until that surplus space gets absorbed or maybe repurposed, that sector is going to stay sluggish.
Right, so this real tale of two or maybe three markets, booming industrial, stable retail, struggling office. How does all that variation translate into the overall commercial lease rates and maybe investment opportunities across the valley?
Yeah, if we connect the dots to the bigger picture, industrial rents, they keep climbing gradually, driven by that tight supply, strong demand. Retail rents, holding steady, maybe inching up in the best locations, helped by low vacancy. But office rents, yeah, they're under significant pressure. Landlords are offering concessions pretty frequently. But importantly, analysts are noting that the broader Southern California commercial market seems to be finding its footing. Vacancy rates have likely peaked. Rents in many sectors might be near their cyclical lows. That suggests stabilization is happening. We probably won't see further drastic drops in rent or occupancy now. So for investors, it means there's maybe increasing clarity, even if growth isn't immediate everywhere.
Okay, let's look ahead then. Crystal ball time. What's the residential outlook shaping up to be for the rest of Q3 2025 in the Antelope Valley?
The housing market is expected to stay pretty stable, but with that gradual cooling continuing, we anticipate probably only slight changes in home prices. Think low single-digit percentages, either up or maybe slightly down. Affordability is still a big factor, right? With 30-year mortgage rates hovering around, 7%, those multi-year highs, that's going to cap any big price spikes. But on the other hand, demand for housing in this growing region should prevent prices from really falling off a cliff either. Palmdale,
Mm.
still technically classified as a seller's market. Lancaster's market is looking roughly balanced now after being more seller-favored last year.
Okay, so balanced overall, more options for buyers, you said. Maybe even a bit more negotiating leverage.
That's exactly. Yeah. Buyers can definitely expect more inventory to choose from than last summer. And yes, slightly more negotiating leverage seems likely, especially if listings keep rising like they have been around that 5–6% monthly increase mark. Now, well-priced homes, the move-in ready ones, they'll still attract competition, sure. But overall, sales activity will probably stay below last year's levels. Homes might continue to spend a bit longer on the market, and price reductions on listings that have been sitting a while, those could become more common as sellers adjust their expectations. So yeah, resilient market, but definitely not overheated.
Got it. What's the biggest variable, though, the kind of crucial if that could really swing the residential market one way or the other in Q3?
Well, one really intriguing finding is just how sensitive this market still seems to be to interest rates. It's a big if. If mortgage rates happen to decline later in the year, or even if they just stabilize, stop rising, that would immediately boost affordability. And that could really spur a late Q3 uptick in buyer interest. You might see things pick up a bit, but, absent that, Q3 will likely just finish with these continued slow, sustainable market conditions we're seeing now, tied pretty closely to the current rate environment.
Okay, makes sense. Now let's shift back to the commercial side for the Q3 outlook. What's the overall picture shaping up to be there?
Generally positive, I'd say, but with some definite caution needed for certain sectors. Industrial and logistics.
Yeah.
Expected to remain the undisputed bright spot, no question. With that strong leasing momentum, industrial vacancy should stay low. It might even tighten a little further. We anticipate industrial rents will probably edge up or at least hold steady at these high levels. Demand just keeps outpacing the supply of good quality industrial space. We might even see announcements for new warehouse developments, maybe business park expansions, as developers respond to all that interest. Yeah, the industrial market is clearly going to lead the region's performance this quarter.
Right. And what about retail and office for Q3? What kind of strategies might we see from landlords with those properties?
Retail sector. Expected to see pretty steady performance. Consumer spending seems solid. Those neighborhood centers are enjoying high occupancy. We don't foresee much change in retail vacancy. Rents will probably stay flat or maybe rise just modestly in the prime spots. One trend to keep an eye on, though, is this adaptive reuse idea. Redevelopment of older retail spaces. Landlords repurposing vacant big box stores for something new, something more in demand now. Overall, it's a stable outlook for retail, helped by population growth and that lack of new construction. Now, for the office market, Q3 is likely to bring, continued challenges. Let's be honest. We don't expect a significant improvement in vacancy. It might stay high, maybe even tick up slightly. Lease rates, still going to be tenant favorable. We'll probably see more short-term renewals, creative deal structures. That said, there are maybe faint signs the worst could be over. Owners are starting to adapt spaces. Think about new uses like medical offices, co-working. But any meaningful recovery, that's likely beyond Q3.
Okay. Finally then, what about the broader commercial investment market in Q3? What's going to drive activity there, and how does the Antelope Valley's kind of unique profile play into that?
Investment activity in Q3, it's going to hinge almost entirely on the interest rate climate, squarely. High borrowing costs have definitely cooled off a lot of investors' appetites. That's clear. But there is significant pent-up demand just waiting on the sidelines. You hear that a lot. Industry experts have been pretty optimistic that if rates decline or even just stabilize, it would really boost commercial sales. If rates stay high, though, transaction volumes will likely just remain below normal levels. However, and this raises a really important long-term point for the Antelope Valley specifically, you have to consider that projected 37% job growth over the next decade.
37%? Wow.
Yeah, driven by those expanding major employers, aerospace, logistics, that fundamental economic strength, it continues to draw long-term interest. And it should translate into sustained demand for housing, retail, and especially industrial space moving forward, almost regardless of these short-term rate fluctuations.
Okay. So if we pull this all together for you, the listener, Q3 2025 in the Antelope Valley looks like, incremental progress, a housing market that's cooling gradually but still healthy, a commercial sector led by really strong industrial and stable retail performance, office sector still struggling, and that broader investment activity. It's kind of waiting for more favorable financial conditions. But the Valley's long-term growth story remains pretty compelling. That was a truly illuminating deep dive into the Antelope Valley's real estate landscape really brings home the idea that real estate, even within a bigger metro area, it just has its own unique story, doesn't it? It's not all one thing.
Absolutely. It really highlights how essential it is to look beyond those broad national trends. You have to drill down into specific submarkets like this, understand the distinct forces at play. They're often counterintuitive, especially when you look at different property types.
Definitely. So here's a final thought for you listening to mull over. If the Antelope Valley really is projecting that remarkable 37% job growth over the next decade, driven by big employers in aerospace and logistics, what innovative solutions might start to emerge in the coming years to address that sustained demand for housing, for retail, for industrial space, especially if interest rates stay tricky? And, how might that long-term growth really shift the balance of power between buyers and sellers, landlords and tenants in the years ahead? Something to think about.